All right, everybody. Hello. Welcome to the ARMR Report. It's a Tuesday. It's Fed meeting. We're going to get into all that type of stuff. Let's remind our new viewers what this is about. This is a show about stock market investing in the millennial age. So we use fundamental traditional tools to figure out themes that we want to invest in, and we use millennial tools to execute. That means algorithms, first and foremost. I like to start with the big indexes first. We have proprietary algorithms designed to tell us when to add risk, when to subtract risk. And as an investor, you can use these algorithms and this show every day at 12 o'clock to help you understand when the window's open to put on positions that you like and when the window's closing and you better book some profits and protect your capital. Step one is to look at the S&P, the Dow, the NASDAQ 100, the small cap index, and the momentum index. Those are the top five we like to use. We're using exchange traded funds to trade here and invest here. And so we have this triangle like this. At the bottom, the base are those five big indexes. That's where we put a lot of capital when we get a new risk on opportunity. And then we go up that pyramid. We're adding the next layer, which is basically group investing using exchange traded funds for groups that we like. And at the very top will be individual stocks in those groups. So when we're fully invested, we have all three positions or blocks or however you want to state it in our portfolios. And when we're in this position now where all five indexes are telling us to be in cash, and we've been telling you that, and we've been positioning ourselves for this starting in September, at the end of September, we are in various positions of cash in our three model portfolios. So we have an affiliation with Interactive Brokers. You can see on our website, rosenthalcapital.com, I update for you as often as necessary what each of the portfolios is invested in. And for lack of a better way to describe it, we have a conservative, a balanced, and an aggressive approach to stock market investing in the millennial age at Interactive Brokers. This is my own private capital, family capital that's in each of these funds, or I should say these model portfolios, and partner capital that can invest by linking to each of the portfolios. So whatever we do with our own capital executes in your account. That's how this works. So you can go as far as to work with us that way, or just use this information every day to help you manage your own portfolio wherever you have it from a risk on, risk off standpoint. ARMR stands for Algorithmic Risk Management Research. So without further ado, let's get to it. Top five indexes tell us to be in cash. For our conservative portfolios, we're still 90% U.S. Treasury bills. We have 10% of our portfolio there invested in a new investment idea, which I'll share with you later at the end of this show. It's a theme and a group we've invested in on and off for the last couple of months, booked some small profits in, and now we're looking to take positions again there. And I have to update you on a theme that we had to let go of yesterday to protect capital. But I'll get to that later. I want to start with this first layer, these five big indexes and how we trade them. And how they affect our investing process, whether we're long-term buy and holders or we're trading on an intraday basis. These algorithms and the information that they provide have merit across the investing landscape. Long-term holders and day traders. It has merit no matter how you like to put money to work. You just take the information and express it differently. So for a conservative long-term buy and hold guy who wants to try to hold through the swings, when we're telling you at the end of September, start to book profits because we have a problem here developing in small caps and mid caps, you determine what part of your portfolio you can let go of. You start to prune the tree, you start to protect a little bit, but maybe you don't let go of your favorite investments. But when we come at you at the beginning of December and we say, hey, man, in our aggressive portfolios, we are shorting the market, something we haven't done in 3 years. 3 years. Then you have to take notice and you have to get more aggressive in protecting your portfolio, whatever that means for you. All right, so let's get into the day trading process of this. I'm trying to update you guys as fast as I can on Twitter. You can follow me at hashtag ARMR Report. Ooh, we're into a big trade right now. This is a live trading desk, guys. So I've got screens all around me and I'm actively trading right now. And I have an aggressive long position on the indexes on an intraday basis. Geez, I'm wondering if I should be booking some profits in here. We just had a big stick higher. No, I'm going to give it a little bit more room and I'll raise my stop on this. All right, so let me explain to you what I'm doing, okay? If you follow me on Twitter, it's hashtag ARMR Report. You can also find me on StockTwits, and I'm updating, showing you pictures. I'm showing you charts and graphs of why I'm doing what I'm doing. So on a multi-day basis in our aggressive portfolio, we're short the market through equity index puts. And we're using puts on the exchange-traded funds of the S&P, SPY, DIA, QQQ, IWM, those 4. And we've been short. I should say short/long the puts since the 4th of December when I came on the show and I said, bear market has begun for the market. And that's why I call these podcasts now Stalking the Bear. This is episode 3 of Stalking the Bear. And I'm going to keep up episode 3, 4, 5 until we feel that the bear, is dead and it's time to start looking for the bull. So when I come into the day, short the market, we had a huge day yesterday, right? We got all these equity index puts. We're up 100% on those puts. We've doubled money on those puts in a very short, it's like a week. Okay. We were booking some profits at the end of the day yesterday for one very simple reason. What I try to do every day is get on the right side of probabilities and statistics, which means if all of our algorithms are telling us to be in cash/short now, we're going to put those positions on. But when the market, or the asset, I should say, gets far enough away from the volume weighted average price, and we have our own proprietary VWAP, we call it the RCM VWAP. When we get X standard deviations below that VWAP, on the big indexes especially, there's like a 90% chance that the very next day, that VWAP gap is going to close. So at the end of the day yesterday, we're more than 3 standard deviations below the closing VWAP. And literally in the last couple of minutes of trading, we booked some profits across the board on all 4 of our put positions. 100% profits. Expecting what happened this morning. This morning was a gap up to the VWAP. It's completely normal. It's like a 90% trade right there. And if the market had gapped down this morning, I submit to you that it would have been a gap down reversal that would have ripped higher and closed the gap. There's 2 ways it happens. It either gaps down and reverses higher. And if it had gapped down this morning, we would have been buying more of our puts. Selling more of our puts, booking profits. But if it gaps up to that VWAP, then we start trying to decide, okay, what do we want to do here? And I said on Twitter, if it comes back down and tests and closes the gap, that we're going to be looking long. Small caps closed the gap. The S&P almost closed the gap. The NASDAQ is the strongest performing index. It did not close the gap. And the Dow is close behind there. So I did not get a chance to sell more of my puts. I don't want to right now. Because of the way the market's behaving, what I did instead is around 11:30, we put on a big long position on the S&P, SPY, and the triple Qs, QQQ, for an intraday trade. That trade was determined by intraday trading algorithms that we've written that look for location and triggers using VWAP, the RCM VWAP, as our major guide, and Fibonacci extensions in either direction to tell us when to put a position on for the highest probability of success. And we're crushing it right now. I really have to figure out where. In fact, you have to excuse me. I'm gonna book a profit right now. I'm gonna book a little bit of a profit, just a little. Can I get something out here to recognize the success at the moment? Just a little something, and then raise some stops. You know, I don't want to touch my stop, actually. I've already got it in a good position. But what I do need to do is cut this position size down. Okay, great. The dance now, when you get into a great long day trade like this, is not to be penny wise and pound foolish. We got a big short position on. We booked some good profits yesterday. It's now going against us a little bit. We own the puts, so we're long the market, and it's really a hedge right now. And so what I'm really hedging against is a rip higher, which I think is very possible. And what I'm looking at, you're watching the sausage being made right now, guys. I just can't focus on the podcast and the live stream at the moment because I'm literally in these trades. I have big positions on the triple Qs and the S&P SPY. Okay, so go to my Twitter feed, hashtag ARMR Report, or look me up on Stock Twitch, and you'll see I put up a picture of the S&P to let you know what was going on. I showed you the VWAP, which is the black dotted line. And I said we opened right at the VWAP. That was the gap closure. So this is, that was a pretty easy, like a 90% of the chance. And here it is, just proved it again. It went right back to the VWAP. So now the question is, how high is this rally going to go? And where are my targets? I just sold some because the NASDAQ just hit the first target I'm looking for. All four indexes, 5 actually, even momentum index, dropped below the low of this bear market, which happened like a week ago. Took out the low yesterday, so crushed through the low. So on that chart I put up for you on Stock Twits and Twitter, I showed you the S&P, and I said the red dashed line is that low. And it's natural and normal after a sell-off that closes on the lows to snap back to the VWAP and possibly extend back and test that low. You took out the low, and then you go back and test it, and you see how you behave when you get back up there. The NASDAQ just got back to the price. So the triple Qs are gone through the price now, which is around 159.50. We're at 159.65 and moving higher. The S&P, SPY, we're looking at a price of, call it 159, okay? 158 3/4, 159. Okay? So When the S&P gets up to that price, I'll book some more. I also have some targeted points where I'm going to be selling more of the NASDAQ on the way up, the triple Qs, and booking these profits. So I'm taking short-term day trade gains on the long side while I'm holding multi-day short positions through puts, some of which I booked at 100% profit yesterday at the close. All of this behavior that we execute in our model portfolio at Interactive Brokers is executed with the control of algorithms. This is how algorithms can really help your portfolio on an intraday, multi-day basis. Again, if you're a buy and hold guy following the traditional idea of doing research, fundamental analysis, owning companies, this information still helps you. I'll give you an example. You would be out of the market during the meat of the collapsing here. And then when we start to get the next risk on opportunity, you're adding to your favorite names. And during the sell-off of October, November, and December, you're doing research, shoring up your whiteboard, narrowing what stocks you want to own. So when we come out and say, hey, man, now's the time to put money to work based on our 5 indexes, you can start adding back your favorite names. If you're a long-term buy and holder, though, you wouldn't do anything today. This is just short-term movements and hedging. So don't forget, ARMR stands for Algorithmic Risk Management Research. In our opinion, risk management in the millennial age is the number one way to add alpha to a portfolio. And so if we're going to be short on a multi-day basis, we're holding shorts overnight, then it behooves us to hedge those intraday if the right opportunity presents itself, which it is today. On a cautionary note, one reason why I'm not wildly bullish right now, and I'm thinking of booking a little more right here, is that the small caps have yet to join this rally. And those of you following these podcasts know that the bear market started with small caps, and we're telling you it's going to end with small caps. When the small caps begin to outperform / stop going down, building a base, then we know that the dangerous part of the bear market is over, and we can really get more, biased towards the bullish side. But today's a perfect example. NASDAQ is ripping to highs, okay, which is great. S&P's following, Dow's coming on, and the small caps really can't get out of their own way. They're still below today's VWAP. Now they might come on in here. They might kick in at the very end of this move. But what I'm looking for is for them to lead, not lag, on the upside. They're leading on the downside every day. So if small caps were ripping higher right now, I would be much more bullish. And, we're just not getting that. That small caps cannot get above today's VWAP, and they can't get above yesterday's closing VWAP. So the only index that's doing that right now in a big way is the triple Qs. The S&P is doing it, and the Dow is doing it, but to a lesser extent. So once again, we have a disappointing move going on in small caps. Even if they catch up here, that's not how I want it to play out. I mean, it doesn't matter. The market's not going to do what I want all the time. But what I mean is, what would give me more what's the word I'm looking for? What would get me to be more bullish and start thinking, hey, maybe the sell-off is over, is if today's rally wasn't led by the triple Qs, but was led by the small caps. That's not happening. All right, anyway. So this show turned out to be totally different. You're literally, in the cockpit with me trading today and witnessing how we book profits and how we hedge positions and how we manage risk in a real live portfolio, and a portfolio that we manage at Interactive Brokers as a model portfolio that we link to. And so it's hard. I'm a little bit distracted because it's a lot of money at risk, and I'm looking to make sure I execute appropriately. Right now, the small caps are starting to break above today's VWAP. So the next stop will be the overnight VWAP, see if they can do it. Okay, let's move on. Let's move on from now. A couple of thoughts for you before we go. I just saw a statistic that this is the worst December since 1931 for the equity markets, the S&P and the Dow. I don't know what that means. I see those statistics all the time. CNBC loves to trot them out. Ken's show is a complete waste of time. They just rehash a bunch of stuff from the last 50 years. It means nothing in the millennial market. But it certainly sounds scary, right? Last time this happened was 1931. It has no value to managing money in the millennial age. It's just kind of fear-mongering. I did like something that on my Twitter feed, I retweeted a Michael Santoli from CNBC put out a couple of interesting tweets I thought were worth looking at. One of which is the Fed chair is in a beautiful position right now because the market's gotten crushed in front of the news, right? So it's almost like whatever news comes out at 2 o'clock tomorrow could be considered bullish, unless the market runs too much in front of the news. Like if this rally really rips all the way to the close and is up big in front of the announcement, then I would disagree with that. But the fact it's been crushed in front of it, it seems like just a relief rally at the end of the year would be normal. But Santoli also said something that was very important. And I don't usually, you all know me, offer praise to CNBC or any financial news network talking head. So this is really noteworthy for me because I think most of them don't know what they're talking about except for Jim Cramer and Rick Santelli. But Mike said something important today. A rally that lasts for a couple days on the back of the, I'm paraphrasing now, on the back of the Fed announcement won't change the direction of the market at all. I couldn't agree more with that. Now, I've put up a blog post that I'm going to be updating periodically called Rules of the Road. I've been investing for 30 years. You all know this story. I've developed a lot of rules of the road, and I'm putting it together for you on a blog. You can go to our website, Rosenthal Capital, click on research, and you'll see the blog post. And one of the rules of the road in there is exactly that point. A rally that lasts for 2 days in a downtrend means nothing. 3 days in a row means there could be a change in trend. 2 days means nothing. I don't care how big the rally is. It could be a huge rally for 2 days means nothing. Totally normal in a downtrend. You're so oversold that a rip higher today and tomorrow won't mean anything. It'll be what happens Thursday and Friday that matters. So if you're wondering what I'm going to do with my put position, we booked some profits already, 100% gain. We're long the equity market right now in the rally, so we're protecting our short position. Okay. And I would wait to see where we are Friday at the close before I dramatically change my put positions. That's my guess. We'll have to see. All right, moving on before the end of the show here, and I really should get going because there's a lot happening, and I have to manage these positions correctly. But excuse me, 2 things I wanted to tell you. Number 1, we've made money twice, and hopefully you've made the money with me, on the gold and silver stocks. GDX is the ETF we trade normally, okay? I'm not long that index right now. That index is, I said for a couple of months there, 19 was the low that had to be watched. It held that low. It broke out above 20. Right now, GDX is trading up at 21. So there's a real move on there. And the number 1 stock to buy, I think, in the group is Royal Gold, RGLD. I put that out yesterday on Twitter and Stock Twits. The stock Royal Gold is up $3.25 right now. No, up 3.25%, which is $2.50. I added to some more this morning. I'll probably finish it off with a bigger position by the end of the day. That's the way I'm going to play the move this time. I think silver's lagging, and I'd love to buy some silver, but I'm just not there yet. I might just start with Royal Gold. Don't forget that's a royalty play and has a dividend. I had to cut out the pipelines, much to my chagrin. You know, it's one of my favorite groups, but it hit a stop yesterday, and I'm out of the pipelines for now. I can't believe an 11% yield isn't attractive, but the price of energy continues to implode, and I can't fight with stop losses. So I step aside, I take a loss, and I wait to re-engage if the stock and the index and the group can prove that it can hold a bottom, which it can't do at the moment. In fact, AMLP is down another 2% today. So, hey, you win some, you lose some, and you got to follow disciplines and follow stops religiously, particularly in this market. Okay. So I think that's it for today. Oh, I did put up a new post on the cannabis, marijuana, hemp, whatever you want to call it, super investment cycle. Take a look at the post on our website, rosenthalcapital.com. It's a post I'm going to constantly update. I'm going to pin it to the top of our blog. I feel that the investment cycle in cannabis is a super cycle that is unfolding in front of our eyes and is at the very top of the whiteboard for us. So this post will constantly be updated with stocks in the news that I think we all should pay attention to, news that's got to do with legislation that affects the industry, and anything else that helps us really understand the investment possibilities of this group. It's something to pay attention to. Thank you all for being with me today. Have a good luck trading today. Be safe out there. It's dangerous right now. Protect capital. Nothing wrong with holding treasury bills, and wait for the next risk-on opportunity using our algorithms. Take care, everybody. Thanks for listening.